Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How you doing this morning, Ty?
I'm doing pretty good. How about yourself?
Good. We've got a good topic today. We're going to be talking about the criteria we use when picking stocks for the managed portfolios that we have for clients. It seems to be that a lot of clients have an affiliation with stock. They like to see stock. They've either worked for a company that is publicly held, so they hold the stock dear to their heart. Others just tend to think that it is a way to generate wealth, and we know it's just one of the many ways. But today we're going to look at the criteria we use, Tyler and I, as financial advisors when we pick stock for managed portfolios. But remember, Tyler and I are in this business full-time as financial advisors. We review corporate information, stock information. We analyze the industries and sectors they're in. We look at economic trends. So we do this for a living. But we're going to let you in on a couple of very basic things we look at before we put the stocks in the portfolios. And the main thing here we're looking at, we're going to look at some technical data versus fundamental data. And the technical data is, it can get very deep. The fundamental data are some of the obvious things you should be looking at before stocks go in a portfolio. So the first thing here we want to talk about would be the sectors. This is a term that a lot of people are familiar with. There are certain sectors of the market that stocks fall into. And there are 10 sectors. You might have heard of some of them: financials, utilities, consumer discretionary, consumer staples, and so on. So when looking at putting stocks into a portfolio, we look at which sectors are performing well and why they're performing well, which sectors are performing poorly and why they're performing poorly. And then we make certain decisions around that. If we're looking at stock positions that we would like to see in a portfolio for the short term, you might look at sectors that are performing well. If we're looking at some value opportunities, we might look at sectors that are out of favor at this particular time for whatever reason, but we believe they will trend back into favor over time. It has to fit in that time frame that a client has, whether it be for retirement or it's an investment they're going to hold for maybe some legacy planning or for their beneficiaries. Tyler, anything that I missed here as an introduction?
Nope, just said talking about sectors. We make sure that we want to evaluate all sectors before closing in on a particular industry or a stock that we pick or choose. And Dean, pretty much, or what's pretty common when we talk about sectors is we sometimes find where clients feel the need that they need to buy stocks in all sectors, every single sector, to make sure they have all their bases covered. And quite frankly, that may be a good thing, but that doesn't always have to be the case. If there's a sector that's been performing poorly for a few years, don't feel like you have to pick a stock just so you can have a stock in that sector.
That's true. That's very true. And again, it tends to be one of the pitfalls that we hear from clients when they come in. Well, why don't we have this particular stock in this sector? We heard it's a good thing. Well, again, let's do some fundamental research and we'll cover those things. The other thing, too, is understanding the industry. Some people will want to see certain industries in their portfolio, but if that industry is not understood by us and or the clients, we typically shy away. Warren Buffett, I believe, is the biggest advocate of this. He says he will not invest in something he doesn't understand. A very basic principle from one of the best investors over our generation. Tyler, anything else about understanding the industry?
Nope, I just wanted to reiterate that's really a big one here, Dean. And before we can even get into a particular stock in that industry, we've got to know the industry. We've got to do research on the industry, research the fundamentals of that industry as a whole before moving on to the particular stocks within the industry. So just that's a big one that we look at is we've got to educate ourselves ourselves on that industry before we can pinpoint any type of particular stock within that industry.
Okay, so we looked at some fundamental things here, just understanding the industry and some sectors. We look at that broadly before we really drill down on individual stocks. Now, when we're looking at individual stocks, let's say we have a basket of stocks we would like to review for a managed portfolio. And one of the technical indicators is the PE ratio. Tyler, can you take our listeners through the PE ratio and why it's important?
Yep, PE ratio, that's probably foreign to a lot of people, but that's one of the main ratios that we use when evaluating a stock and deciding whether or not we want to buy into that stock or not. And listeners out there may be asking, well, what the heck does PE ratio even mean? What PE ratio means, it stands for price to earnings ratio. And that measures the price of a company's stock relative to its earnings. And it's calculated by the stock price divided by the company's earnings per share. And there's a number of different websites that you can go out to, and you can find all that. You don't have to do any of the math. It's all out there for you in today's day and age. So really what our job is to interpret that number, the PE ratio. And the PE ratio, essentially what it comes down to is it's all about a company's value. So it tells us whether or not a stock is overvalued or undervalued. And a higher PE ratio could mean it's overvalued. A lower PE ratio could mean it's undervalued, but that doesn't happen like that all the time. And when we look at the PE ratio of a stock, we compare that stock's PE ratio with two things. Number one is the current PE ratio of the S&P 500, which is the market. That's what people refer to when they say the market is the S&P 500. And right now, the current PE ratio of the market is about 26. So that's the first thing we compare it to. The second thing that we compare it to is the industry average. So whatever stock that we're looking at, we want to compare it to the PE ratio of the industry. And we'll compare it to those two things, and that will tell us whether or not the company is either overvalued or undervalued. Now, with an overvalued stock, right now might not be the right time to buy into it. Whereas an undervalued stock, if we find that it's undervalued, we might want to buy into it right now just because it could grow more in the future. And right now would be a good buying opportunity if it is indeed undervalued.
Okay, so as an example, when you say you look at the industry itself, you look at the stock's peers. So for instance, if you're looking at a telecommunications stock and you see that its PE is around 14, but all of the rest of its peers in the telecommunication might be up around 20, that is reason for more investigation to find out why it's valued so cheaply, I guess, versus the peers, correct?
Exactly. That's exactly how it works. That would show us that stock is not only undervalued compared to the market, compared to the S&P 500, but it's also undervalued compared to the rest of the stocks in its industry or the industry average.
Okay, so when it comes to PE, we also look at things and we use the terms value and growth. So as an example, and this isn't written in stone, but if you have a PE of less than 20 on a particular stock, we typically start to look at this as a value opportunity or a value stock. Now, some of the characteristics of a value stock is that they typically have longevity on their side. Many times they pay a dividend instead of reinvesting the money into growth of the company. They maintain and they will pay dividends out to their shareholders. So value is typically less than 20. And when you start getting over 20 and into the 30s, 40s, and sometimes even the hundreds, you're typically looking at growth stocks. And many times when you see a high PE, you will see that those stocks do not pay dividends. And part of the reason is they are taking their profits, income, and their expensing towards their growth. It could be research and development or another product line that they're putting out there. So when you're looking at a basket of stocks to go into managed portfolios, value typically gives you a long-standing company that many times will pay dividends, but not give you a lot of unrealized growth typically. And then if you look at growth stocks with a higher PE, they typically give you the opportunity for more upside growth, but they also give you more volatility typically for downside. And many times those companies that have a higher PE and are considered growth also do not pay dividends.
Exactly. And Dean, just because a stock might have a higher PE ratio doesn't necessarily mean that it's overvalued. It might just mean that it's a growth stock. And if the company is growing quickly, then a high PE ratio may not mean that the stock is overvalued, just that it's a company whose earnings are growing so quickly. So in that case, it might be hard to tell if that high PE ratio is due to expected growth or if the stock is simply just overvalued. So that's something to keep in mind as well, just that if it has a high PE ratio, it doesn't necessarily mean it's overvalued. It might just be a growth company.
Okay. If you're just tuning in, my name is Dean Listle with Secure Retirement Solutions. I'm here with Tyler Listle, also of Secure Retirement Solutions. We're investment advisors. If there's any information you'd like from us or have questions about today's topics, you can call us at 920-347-9888. We're located on Allied Street in Green Bay. Or for more contact information or find out more about us, you can go to our Facebook page. My Facebook page is Dean Listle. That's Listle, Secure Retirement Solutions. And Tyler's Facebook page is Tyler Listle, Secure Retirement Solutions. Or go to our website at srsplans.com. Okay, to continue the evaluation, we look at something else a little bit more towards the technical side, again, like the PE ratio, and we refer to it as beta. Beta measures the stock volatility. That's important to know. When you look at your holdings of stock in your managed portfolio, you also want to scrutinize the beta, or we scrutinize the beta. Part of the reason is, do we want to be riskier than the industry norm in the S&P, or do we want to be less risky? Well, it all depends on your time horizon. It depends on what stage you're in as far as life. Are you in your 20s, 30s, 40s, or are you in your 50s, 60s, 70s? So it all depends on that. But beta really measures the volatility of a stock, and here's how it works. The S&P 500, of course, made up of 500 stocks, companies, I should say, has a beta of 1. If you have a stock that has a beta of less than 1, you are less volatile than the S&P. If you have a stock with a beta greater than 1, it has more volatility than the S&P. Not tried and true, but there are also indicators here that, again, show value versus growth stock. Many growth stocks will be it'll have a beta greater than 1 in the S&P. Many value stocks that have been around longer and pay a heavier dividend over the long term have a beta of less than 1.
Exactly. And Dean, when you said the beta measures stock volatility, essentially what that means is the risk of a stock. So if it goes up or if it goes down, that's what the beta is going to measure. And for example, like you said, the S&P 500 has a beta of exactly 1.0. So if we're evaluating a stock and it has a beta of 1.1, that simply means that stock is 10% more volatile than the market. Meaning if the market were to be on a trend upward, on average, historically, it's gotten about 10% more return than the market. However, if the market were to dip downward, it also got 10% more on the downturn than the market. Whereas if a stock were 0.9, it'd be 10% less volatile than the market. So beta is a measure that we factor in when evaluating stocks in regards to how volatile they are compared to the market. It simply means the risk compared to the market.
Okay. Another thing that we look at are the financials of the company. Now, years ago, you would have to go out and actually get involved with conference calls, request information on the financials of publicly held companies. But with the internet right now, there are a number of websites out there that deal with stocks and the financials, everything from Yahoo, Google, MarketWatch, Morningstar, and many of the others out there. They will provide financials, usually in the form of a balance sheet or a 10K, and we'll talk about that a little bit later. But what happens here when we look at financials, if you have a background in financials, wonderful. If you don't, there are still some very basics you can look at here. For instance, a balance sheet is what you would like to scrutinize a little bit if you're thinking about investing in a certain company or buying their stock. This is what we do. We look at what's referred to as the top line. The top line is revenue. We look at the bottom line, which is profits. And of course, there's much more that goes into it with scrutinize everything else that comes between the top line and the bottom line. But some of those items that we like to look at when it comes to the financials, we'd like to see if they're a dividend-producing company, what is their history of dividend payouts? Now, there is a term called dividend aristocrats, and these are publicly held companies that have paid in increasing dividends for over 25 consecutive years. That is a wonderful trend. Not all companies fall into that category, but if you go back and scrutinize their history of dividend payouts, you can see years that they might not have paid dividends. You might see years that they decrease dividends. You might see a wonderful trend of increasing dividends. So dividend payout history says a lot about the company, should be analyzed over the either life of the company or at least 10, 15, 20-year average.
Yep, exactly. And Dean, when you touched on the top line revenue versus the bottom line profit on the balance sheet, that's one thing I want to elaborate on a little bit. And when we evaluate stocks, one of the main things that we also look at are the profit margins of a company. And with that said, we want to see companies who are growing their profit margins. And profit margin is calculated by dividing a company's net income over its revenue. So it measures how much earnings the company brings in for each dollar of revenue it has earned. And what this does is this really tells us about a company's ability to manage their expenses and costs, and it shows how much revenue is truly being converted to earnings. And for example, if we're evaluating a stock and we see that over time the profit margins are shrinking, they're going downward, that might raise a red flag right there, because those earnings are not being paid out to shareholders, not going back to the company. So profit margins are one of the main things that we look at when evaluating stock. We want to see companies who are growing their profit margins. And keep in mind, I'm providing these different equations and formulas, but all these are out there, like I said, in today's day and age. It's just our job to simply interpret what that number means.
Okay, that's a good point. And also, I'm going to go back to dividends here for a minute. On the Motley Fool website, they have a little booklet called Investing Help for Beginners, 10 Things You Need to Know Before Buying Your First Stock. And in that little booklet, they claim that over the past 80 years, dividends were responsible for 44% of the total return of the S&P. That alone tells you why we pay close attention to dividends. Dividends can be a wonderful thing for a portfolio. Those dividends, especially when you start getting up to your retirement years, as dividends are coming into those portfolios, those managed portfolios, they can either be reinvested back into the stocks that created them to create more shares, or they can be spun off and sent into your checking account as a form of income. So you will hear people in retirement, most specifically, they will claim that they are living off dividends from certain portfolios or stocks. That's the situation here when it comes to dividends.
Exactly. And one thing that we look at with dividends is the dividend yield. And dividend yield is the annual dividend divided by the current share price. And dividend yield is a way to measure cash flow you are getting for each dollar invested in a particular stock. And for those clients who come in, and we have quite a few clients who come in and they're familiar with stocks, they like to hold stocks in their portfolio, but they're also looking to retire and they want income currently. That's where we really look at dividend yield, because we'll pick those stocks for clients who are looking for income, and dividend yielding stocks provide income that clients simply have, like Dean said, go directly into their checking or savings in retirement, and it's a form of income. So dividend yielding stocks are really helpful for people who are looking for income currently.
Okay. And going back to the financials here, we talked about, the top line, the bottom line in the financials. We talked about the history of dividends. Also look at what is the debt used for. When you look at the financials and the balance sheet, what are they using the debt for? Is it to grow the company? Is it to pay dividends? There are a number of things that the debt can be used for, so you'd like to find a pattern there. So when you're analyzing the financials, look at top line, bottom line, scrutinize the debt, look at the history of dividend payouts. Also, and this is very easy to find on the internet, MarketWatch is one of them. You can go in and you can see the buying or selling trends from the board members or key executives of that particular company. And it's important to look at, we scrutinize this and we look at that for patterns, because if you have board members or key executives that are selling a number of their shares that they've accumulated over the years, is it because they believe there might be a downturn in the industry? Is it because their sales are off a little bit? Is it because they're in research and development and haven't put the product out in a timely fashion? There are a number of things there. But on the flip side, there's also some trends from a positive standpoint. If you see a lot of buying opportunities or buying trends from the board members or key executives, which are out there for you to see, that also might tell you that there are some excitement and people are feeling very favorable about potential increase in sales or maybe potential acquisition or something else. So you need to scrutinize those trends. It's just one of the many items you look at when valuing a potential stock for a portfolio.
Yep, and Dean, I actually want to go back to the debt real quick. You mentioned that a moment ago, and I think that's important, and many people overlook it, because when we look at the debt of a company, and like I said, it plays a bigger role than one may think, because if a company has a large amount of debt, then that can be a red flag and possible cause for concern, because that means that the company earnings will be going toward that debt as opposed to the growth of the company, as opposed to research and development, as opposed to paying dividends back to shareholders. They're going to be strapped and straddled by that debt. So that's a big thing too, is looking at a company debt. That's something that can't be overlooked.
Okay, good point. Again, if you're just tuning in, my name is Dean Listle. I'm here with Tyler Listle. We're with Secure Retirement Solutions. We're investment advisors. If you have interest in getting a hold of us, you can call us at 920-347-9888. We're located on Allied Street in Green Bay. If you would like additional information about us or our contact information, you can go to our Facebook page. Mine is Dean Listle, that's Listle, Secure Retirement Solutions, or Tyler Listle, Secure Retirement Solutions. Lastly, you can also go to our website at srsplans.com. Okay, again, we're looking at a number of items that go into making a decision to put stocks into a portfolio. In our office, we have a saying that history tends to repeat itself. That is not written in stone, but typically if you look at some companies that show growth trends, they show stability in their financials. They have a good product or service at a fair price. Historically, they have done well. Historically, you need to look at that and say, is that trend going to continue? Now, remember, past performance is not an indicator of future returns. We understand that, but you still need to look at the history of the company to determine their standing amongst their peers or in the sector.
Yep, exactly, Dean. And I want to reiterate on that as well, just that one main thing when evaluating stocks or sectors or industries, we do look at the past performance. We look at charts, we look at graphs. They show us how the stock is done in the past and where they're at right now. And as you said, Dean, that past performance we know is not indicative of future results. But we do want to look for companies that have had quality returns for many years as opposed to companies that have had a short period of solid returns. And oftentimes we find that people get caught up in the recent fads when it comes to a stock, where they want to get the hot new thing over the last year, but they fail to realize that the previous 5 years it was down 20% per year. So we want to look at stocks that have an average, a long track record of quality returns over time and not just a fad. Now, we're not saying shy away from fads because they do play a part in a portfolio. You can definitely go and buy into a stock like that. But over the long term, we want to evaluate and buy into quality companies that have shown a track record of long-term sustained success in regards to their returns.
Okay. So we're talking about the criteria we use. There are also a couple of things. There's some red flags. There's some pitfalls that you don't want to fall into. And we'll look at a couple of those. And I think number one is when it comes to stock, cheap isn't always good and expensive isn't always bad. And I bring this back to a client that I have that comes in the office. And when she comes in and we review her managed portfolio that has stock in it, she'll see some of the prices of the stock, $200, $300, even $400 per share. And she'll say, oh, that is so expensive. I just feel uncomfortable with how expensive that stock is. Well, remember, she is just looking at the share price. The criteria that goes into it, it could have a wonderful and cheap valued PE. It could have growing trends. It could have acquisition opportunities on the horizon. It might pay a wonderful and increasing dividend all the time. So don't necessarily look on the surface when it comes just to the stock price. Okay? So expensive isn't always bad. On the flip side, cheap isn't always good. There are some very cheap stocks for a good reason. Maybe their performance isn't real good. Okay, so those are kind of things that you need to look at. Tyler, anything on the cheap versus expensive?
Yeah, just that, once again, that's where the ratios come into play. For example, the PE ratio, let's look at that instead of simply the price of the stock. Because really, Dean, the price of the stock, just looking at that and not evaluating anything else tells us very little. We need to get deeper than that to go through the whole process and fully identify whether or not this stock is worth buying into. And just like you said, just because a stock may be expensive doesn't mean it's a bad buy or overvalued. And just because you think a stock's price might be cheap doesn't mean that it's undervalued. We need to get into the financials, like the PE ratio, their debt. We need to go through the whole entire process.
Okay. As we're starting to come to a close of the show today, we'll hit on a couple of other ones quickly here, and that is be cautious of companies that don't earn any profits. You see a lot of companies out there. There's some IPOs of companies that have never made profit at all. Yeah. You have to be a little bit cautious there. What about companies that are under investigation? You can find some of this information on a more detailed report, more detailed than a balance sheet, and that's called your 10K report, which you can find online. So dig in there and find out if the company's under investigation. Also, don't always believe the analyst reports, okay? We understand it's a great guideline. We look at them too. But there are hundreds of different companies that analyze. And it's so funny to look at certain websites that have analyst reports, and you'll see half of them say it's a buy, half say it's a sell. So you've got to be very, very cautious there when it comes to analyst report. Also, don't buy the hype. And the hype is somebody coming up to you in the lunchroom saying, you know what, I got a great lead. I'm making a ton of money on this particular stock. Well, okay, you might have missed a major portion of that growth, or it might be them just talking out of turn and really not telling the truth. So you have to be careful. Do your homework. Tyler, anything else as far as red flags?
No, just we see clients all the time that come in and they say their coworker told them about the hot new stock and they want us to look into it for them. And just beware. Just reiterate, talk to your financial advisor and really get a second opinion on stock picking and different things like that. Okay.
Very good. So we talked about some of the basic fundamentals. We talked about some of the technical information that we look for in choosing stocks for your managed accounts. We hope that this was a good show for you and give you a little bit of information. If you have any questions, again, you can contact us at 920-347-9888. I'm Dean Listle, along with Tyler Listle of Secure Retirement Solutions. And it looks like that's all the time we have this week, folks. We hope you enjoyed the show and you'll join us again next week.
Thank you very much. See you again next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.